What would you do if you had $1 million, and how would you invest it? What is that song? If I had $1 million. So let's talk to Phil this week and see what that might look like here on Phil's Tax Hacks and Other Retirement Facts. Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome into the podcast. Thanks for hanging out with Phil and I. I'm not going to sing that song, Phil. I don't know that either one of us should, but instead of singing, we're going to talk about this reaction in a recent article where basically if a client came in with $1 million, right, to invest, the question was put to 3 different financial advisors, and we'll put a link to the article in the show notes. And just kind of, we're going to talk about their takes a little bit and then get your own take on it, right?
Sure.
And just kind of, how these answers might change depending on age and, just the various different things. So let me set the stage for you here, right?
Okay.
So the 3 advisors were asked, how would you advise a hypothetical investor who is in his or her late 40s, owns a home, has $300,000 in a retirement account and $300 in other assets, and $1 million in cash to deploy in today's market, right? So that's the setup.
Okay.
The pros said, one of them said, what do you think about these different strategies? Do they line up with how you would advise things? So let me do the first one here. So Stephanie Link, I guess, from Hightower, I'm assuming that's where that's at. So diversification, 60 to 70% equities, 20 to 30% bonds and private equity, and then cyclical sectors, dollar cost averaging. So what's your thoughts about Stephanie's comments about 60 to 70% of that $1 million going to equities?
Well, I mean, it's kind of a safe allocation, right? That old 60-40 type portfolio with somebody in their late 40s. I mean, the challenge with coming up with how would you invest this money for this client is, well, I don't know anything yet. All we know, we've got such a limited set of facts that I have no idea where did the $1 million come from.
Okay.
Did he just sell a business or a piece of real estate, and is he looking for a short-term place to park it because he's looking for the next opportunity? Well, that's going to be a totally different strategy. Okay. Versus, well, did he sell something? Now he's got $1 million and he's wanting to put it into more of a long-term portfolio for retirement. I mean, there's 100 different scenarios that you could play. So it's really hard, in this case to say, well, yeah, this is what you should do. I mean, I would say Stephanie's is a kind of a safe down the middle, kind of a
for a 40-year-old,
right? Yeah, 40-year-old. You're in kind of a moderate to leaning towards moderate aggressive in that 70% equity range. Private equity. So yeah, it's not knowing anything else. I would say it's probably a safe bet for them as long as this is a long-term investment.
Right.
But again, the challenge is I have no idea what their intentions are.
Well, we'll go through a couple more of these.
What's going on? Yeah.
Yeah, we'll go through a couple more of these, and then we'll kind of play some what ifs, right? A little bit. So James Thorne from Wellington Altus said, I'd go innovation AI heavy, NASDAQ, S&P, China ETFs, 10% gold and Bitcoin or energy financials, right? So definitely thinking, well, you got $300,000 in a retirement account, you're only 40. You got $300,000 in other assets, again, you're only 40. Let's go risky with this $1 million and see if it pays off big.
Yeah, I was going to say, so he's wanting to roll the dice big time. So yeah. Again, depends on risk. With this client, we don't know how the other 300 in the other investments, whether maybe that's a non-qualified account or maybe that's a piece of real estate or a business, we don't know. Mm-hmm. And in the retirement accounts, we don't know how those are invested either. So really, to go this heavy risk on that limited facts, I would be very leery in that. Because it's got to be the right person. To me, that would be if this client came to you and said, "Hey, I've got $1 million. Let's put it all on black," type of thing. Yeah. Maybe not quite that risky, but
right.
I mean, AI innovation, that's the next wave. We've seen the benefits and
Sure.
What that has done for the markets in the last couple of years already. How long it continues, where that leads, how long this wave rides, we don't know. So I mean, that jumping on that bandwagon, could be some potential there. The 10% gold Bitcoin. I mean, Bitcoin's been another one of those crazy investments this year that's gone up substantially.
Right.
Does it have a place in a portfolio? Absolutely. I think so. We've got it in a lot of our clients' portfolios, but not at that level.
Yeah.
I mean, that's a pretty significant slice of the portfolio in that type of an asset. So,
right.
To me, this would be, you're really taking a risk on type position for a substantial portion of the overall net worth.
And at 40, it may be totally fine, right? I mean,
Right.
again,
if he's planning on retiring at 65, okay, so you got 25 years. If he was early, although I said late 40s, so maybe he's only got 20 years.
I did say late 40s, yeah.
So, I mean, to me, it seems a little risky for this specific scenario, unless that's what the client's saying. Hey, let's take it high risk. They're comfortable with that. They're not planning on touching this money for 20 years.
Yeah.
And I mean, that might be an appropriate position to take, knowing and understanding the risk.
Yeah. And you're touching on these clearly as and again, these were financial advisors, but you're touching on this as well as someone who says, look, I'm all about learning about the person first. And
yes,
granted, we realize we're working with limited facts here in this, in this particular, setup, but just for the sake of the argument, right? So we'll do that last one, and then we'll talk about a few other factors here. And I'm probably going to screw this name up, so I apologize to you, Denis. But Denis Poljak, maybe, or Poljak, from Steward Partners, a little bit more conservative maybe than even Stephanie, saying, hey, risky, saying 70 to 75% equities, and then some conservative bonds like treasuries, right? So being a little bit more, I guess traditional. Right. Than the previous person.
Yeah. So similar to Stephanie's, it's that 70% equity, 75. So, I mean, it's a little higher. So this is more, I would consider like that moderate aggressive type strategy. Again, for just looking at the limited facts based on his age, that could be an appropriate strategy, providing, he has the timeline and not planning on retiring in the next 5 years,
Yeah. Right.
Again, so many limited facts. To me, each one of these scenarios, I guess, tells more about maybe that
their style
advisor and their style. Exactly.
Yeah.
This is kind of their approach to investing. Obviously Wellington, I mean, it looks like they're a very heavy equity, all in type of
innovation. All that kind of stuff. Yeah.
There's nothing wrong with that, but
no, exactly.
The advisor you're working with and what their strategy is.
Exactly. And that was the point of doing a conversation. These may be bigger firms. I haven't dug into them or not, versus maybe more boutique firms like yourself.
Right.
So let's talk about like the age factor. Okay. Let's see how this changes the answer a little bit. So obviously we're talking 40s, late 40s. Everyone seems to be a bit more aggressive on the growth, right? With some alternatives because you got a longer runway. Now, Phil, let's just say that this person's now late 50s. Now, what would you do differently?
Well, again, it comes down to what their scenario is. You have to understand the full facts. Number one is when do they anticipate retiring? Even somebody in their late 50s, age by itself isn't the only factor to consider.
Okay.
If there's somebody in their 50s and they're not planning on retiring until 70s, well, we got a 20-year runway, so it's a much different timeline. Mm-hmm. And if they're comfortable with risk, well, then should we really take as much risk off the table yet? Because for them, it might not be appropriate. So I'm not a plug a client in a portfolio based on age type
based
of
on age. Okay. All right.
Because there's way too many other factors that go into it. You have to understand what their expectations are, what their runway is until retirement. And once they get to retirement, what does that look like to them?
Gotcha.
I mean, if they have a high Social Security, they work for a company, they've got a pension, and those two are covering 70, 80% of their overall income needs, well, then, the other money can be invested much more aggressive, because we're only looking at one piece of the equation.
Exactly.
Versus if they only have Social Security, this may be given 30% of the income need and 70% has to come from the portfolio. Well, now we've got to be much more risk aware on that portfolio and how it's invested because of sequence of returns and all the other factors.
The Tax Smart Retiree is your comprehensive guide to mastering tax efficiency for a flourishing retirement. You will find indispensable advice and actionable strategies designed to enhance tax savings, maximize Social Security benefits, protect against market volatility, and develop a customized retirement plan. To get your free ebook, click the link in the show notes of today's episode and download your copy of the Tax Smart Retiree right now.
Well, I'll skip doing the 60 or 70 then, because you basically kind of just set the table for the last piece that I wanted to cover, which is beyond the article, beyond the basic portfolio numbers that we have. What things are missing from the article and the conversation? And you started to touch on that. First and foremost, it would be the Social Security and pension conversation, because, yeah, to your point, if you got $300,000 in retirement accounts already, and you got $300,000 in some other assets, and you've got a job where a pension is going to be possibly happening and a decent, pretty decent Social Security, you might could take that whole $1 million and absolutely go wild, right?
Yeah, so then maybe that Wellington scenario would be fine.
Totally be fine, right?
In his scenario, he's not needing that money for income, so we don't have to worry about the volatility. And if he's that growth oriented, hey, I want to grow this as big as I can, that's a great portfolio potentially to look at, because that is geared towards that type of a scenario.
Exactly. So what are some other things besides that we just covered that are missing from the article? Some other things that you would want to talk to the client about?
Well, it comes down to, first of all, having an overall financial plan, so, and we've talked about this before, where the old adage, right? If you don't know where you're going, any road will get you there. So what are we trying to do? Let's map out what retirement looks like to them, starting with income needs. We talked a little about that. What do they need in retirement? What other sources of income they have? So now we understand what we're trying to get the assets that he has to do.
Yeah.
Once we have that, now we can come back to looking at the next thing would be kind of behavior, emotions, that side of the equation, because if this is a more conservative type investor, well, then that Wellington type portfolio, it shouldn't even be discussed with them.
It's going to stress them out.
It's going to stress them out. And they're going to call you at the worst possible time and say, you know what, I can't do this. I'm down 50%. Just get me out.
Right.
Which is the wrong thing to do. You want to have that discussion early to say, hey, here's the potential. Are you okay with that?
Right.
Knowing that, you have higher maybe upside potential to get that. But you have to be comfortable with those lows in the portfolio to get there. So understanding that emotion.
Okay.
So once you have those pieces in place, part of the plan is the tax planning. And
I was going to say, as a CPA, I was waiting for you to say taxes.
You got to look at, in his scenario, that IRA money, should we or should we not convert it? I don't know. You got to look at the bigger picture, how the other money should be invested. Make sure you're taking into account the whole tax side of the equation long term. I mean, the challenge you have with the amount of money he has in a non-qualified account. So I'm assuming like the $300,000 is just like in a brokerage account.
Okay.
Non-retirement money. And then now he's got $1 million
in cash,
in the bank in cash that he's wanting to invest. Well, those are both what I would call non-qualified type investments, which the challenge there is that even if you're not spending the interest, the dividends, the capital gains that they generate, that's causing a tax liability. So just understanding what that looks like and investing accordingly or not based on the taxes, but understanding what his income need is with taxes in mind, so you're not getting yourself backed into a corner to all of a sudden you get this huge tax bill. So then we talked about, sequence of returns at the end of the day. Once you have the plan, now we know what we're trying to accomplish with the money. Knowing when we're going to need it, now we can develop a strategy around how that money should be invested to help hedge the sequence of returns risk. Meaning, as he's pulling money from this portfolio, as he gets into retirement, we're not having to worry about the ups and downs in a market as much, at least with a certain portion of the portfolio that we're generating income from. So, So at the end of the day, to get the right answer for this kind of case, you need a lot more information,
Right. Are they married? Right.
Are they married?
Liquidity needs,
what's that look like?
Yeah.
All sorts of things.
So it makes me think, and again, this is just hypothetical and you could go a million places with it, but it's like, okay, you got $1 million in cash, and sometimes people have those odd liquidity safety feelings, right? So maybe this person and the spouse are like, we need to see 250 grand sitting in the bank for us to sleep at night, right? So, or who knows, right? So every situation is going to be different. So I think it's interesting to hear what other firms and other pros might go with. And they're probably just saying, okay, look, since it's hypothetical, we know we got to dig in and get more information. Here's what we would just throw out based on those limited facts. Right. Totally fine. But the reality is that every $1 million client or plan, right, is unique, right? Yep. And really it's about your family and it's about your sleep at night factor. I think to your point a minute ago about the emotions that carries a big chunk of the weight. We might all say, yeah, we're in a good place. We want to make as much money as we can with this, but can you sleep at night with it? Right.
Right. So, I would kind of flip it the other direction and say, okay, so if this is this is your scenario and you are talking to these advisors, well, how would you invest this money? If these are the answers you get, be careful, right? I mean, if this person were to come to me and that's their first question, I would say, I have no idea. You're wanting me to build a house and I don't even have a blueprint yet. We've got to we've got to go through a financial planning process to understand what we're trying to do, because otherwise I'm going to propose something that may or may not be right for your specific scenario.
Yeah. Okay.
So we run into this, not exact scenario, but we run into this often with clients where, they'll come in and say, well, so what does your portfolios look like? How does this work? And I'm like, well, I can show you that, but let's step back, because what I show you might not be what ends up in your strategy based on risk and need and all the other factors.
So basically you're just saying, okay, cool. But who are you? Like, who are you? Yeah.
And what are we trying to do?
Yeah.
Right. At the end of the day, we need a lot more information on the individual, their overall scenario, income needs. I mean, there's so many other factors that have to come into play that you need to have that comprehensive plan built first to get the right answer. Otherwise he might be 2, 3, 4, 5 years down the road and he's in a better, maybe worse position, depending on, because they didn't dig in to find out, well, what is he trying to accomplish?
Right.
So
at the end of the day, right, if this is you've got to sit down with a few people, right? Hopefully that's what you would do. Hopefully you would interview and talk to a couple different advisors to find the right fit for you. And yeah, I mean, if you're walking in and you're presenting these 3 or 4 facts and they're presenting you with a portfolio within the first 30 minutes, that's probably not a great idea, right? But if they're taking the time to get to know you, it's a little bit different. But just interesting, a little fun, good for conversation. So hopefully you enjoyed that chat, folks. We'll put a link again in the show notes for the article if you want to check that out for yourselves, as well as to get yourself some time on Phil's calendar. We'll have those links there as well. Don't forget to subscribe to us on Apple, Spotify, and of course here on YouTube. Hit that thumbs up and notification bell to catch new episodes when they come out. And we will see you next time here on Phil's Tax Hacks and Other Retirement Facts.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.